Hello and welcome to another edition of BCR Webcasting. Next month, BCR will be having its third MENA Supply Chain Finance Conference in Dubai. That's on the 5th and 6th of November at the Westin Hotel. One of the important sessions at that conference will be looking at navigating dynamic environments for supply chain finance through credit risk management. So today I'm delighted to be joined by one of the key panelists for that session, and that's Niraj Kumar. Niraj is global head of global transaction banking at United Arab Bank. Niraj, welcome.
Thank you, Michael.
Niraj, this is a very important topic for the region, and the region is going through some turbulent times and difficult times, and the environment there is one of it's an evolving and changing environment. I want to ask you about what sort of tech solutions can help financiers in this environment at the moment.
Thank you, Michael. There are many, but let me take just one example. So right now, I am actively involved in putting up the solution of supply chain finance, which is a buyer-led supply chain finance solution for the bank. And because this is what I am presently involved in, this becomes for me the most obvious thing to tell you where technology helps. So technology today is redefining the way we are making finance available to our customers. So what a buyer-led supply chain finance does is, for the bank, it allows the bank to take a credit risk on a large anchor buyer whose credit worthiness is good, acceptable. And on that risk, it makes available financing to the small suppliers who could be SMEs or micro SMEs who do not have ready access to bank finance. Now, all this would not have been made possible without the use of technology. So today, you have access to excellent, high quality, cloud-based financing platforms, which help the bank to to be on the platform, and at the same time have the suppliers and the buyer also on the platform. Like I said, this is technology which is enabling us to make financing available to small SME suppliers. So definitely, technology plays a big role in this area of financing.
And to what extent throughout the region is credit insurance available? Is it available everywhere, or are there some regions where it hasn't really reached to a great extent yet? Is there still more to do in terms of getting credit insurance available across the region?
Absolutely. So taking a cue from the previous question, and just in continuation to that, so what technology also offers me in terms of the platforms that I just mentioned is to integrate credit insurance as one of the parties who is also a player on the platform, right? So I can have a credit insurance company who underwrites the risk of non-payment on the due date by my obligor, right? In this case, the obligor is the buyer because I'm doing financing on their payables, right? Now, what is interesting and at the same time slightly disappointing for me is that while credit insurance on a single obligor basis is something which is readily available in more developed parts of the world, it is not as forthcoming in the Middle East. Although other forms of credit insurance like whole turnover policy on the default of receivables, that is available. But in this particular case, I would look on a single risk or a single obligor policy, which is not so forthcoming. So I hope that with time this changes, and insurers having access to better data from this region are able to underwrite such policies.
And in a buyer-centric arrangement, would credit insurance allow you to offer supply chain finance structures to arrangements when the buyer may not be a very large blue chip corporate? It may be, you know, a mid-cap size or even smaller. Does it give you that sort of a wider scope to offer supply chain finance products if you have that ability to provide a credit insurance wrap to mitigate risk?
Of course. So there are certain criteria which defines the for each bank it might be different. So for each bank it might be a certain set of criteria which allows them to onboard their customers, right? So for a mid-sized bank like us, it would be something. For a larger bank, it would be something else. As long as a corporate fits that criteria, I should be able to offer them this kind of a buyer-centric solution. Uh, uh, the only disclaimer I would add is that on the lowest size of the corporate that I would be willing to take on for other products, I might not be willing to give a buyer-centric product, but tilted more towards the larger size of the obligors or the buyers.
Mm. Okay. And let's look at risk management. I mean, credit insurers, that's their, you know, core expertise. One could say is risk management and having the right sort of tools, or the best tools perhaps, for credit risk management. To what extent can banks use that expertise for risk monitoring? Use that expertise within credit credit insurers for their own risk monitoring and mitigation.
All right. So let's look at the other form of credit insurance, which is more readily available even in this market, which is the whole turnover policies which the underwriters are willing to do. And that underwrites the risk of non-payment from the buyers, where the supplier is my customer. So for a receivables finance structure, right? Now, this is an area where I'll have one seller with multiple number of buyers whose receivables I am financing, right? Now, my risk assessment will mostly be based on what I assess on the supplier, which is one. But there are multiple counterparties who are the buyers. If I am able to use credit insurance, so if there is credit insurance available for me as a bank, then I'll be very happy to use the information uh, uh, the information that insurers have and their skills and expertise in assessing the buyer entities, right? So it helps me expand my reach of the product to not only unknown geographies, to unknown buyers, because I am using credit insurer as the right tool for monitoring this risk. So indeed, it is very much useful.
Okay. And is this something relatively new that's happening in the region, that credit insurers are coming in to the region to provide these kind of services? Is this relatively new?
Not really. I mean, as long as I've been here in the UAE, which is now close to 18 years, it was always there. So it's not a new thing.
But the tools that are available, the technology that's available to credit insurers that banks can also use for risk assessment, those tools have been improving considerably, haven't they, over the years?
Absolutely. So what we definitely are witnessing now is the advancement of cloud-based tools on which insurance can be a party present all the time on a transaction-specific basis and can underwrite the risk of default there. So these tools are now available, and it helps the way finance is being made available to the borrowers.
Okay, and which you also touched on in the first question I raised. And how important is collaboration between financial institutions, insurers, and businesses? How can how can they collaborate perhaps in a more effective way to strengthen supply chain finance that can be offered by banks? Is there some important synergy there that can be created?
So absolutely, and collaboration is the right word to use here, because look, a supply chain, a strong supply chain is very important for the trade to prosper, right? So a buyer definitely wants the suppliers to, continuously supply the required items, products to the buyer, right? So there is a strength which is required in the supply chain. Now, look at the parties involved in this kind of transaction. So you've got banks, right, who make the capital available to the business, right? Then there are insurers who underwrite the risk of default, who mitigate the risk of default, right? With these two combined, businesses are able to offer better terms of payment to their partners. So, what does it all mean? That all three, when collaborate with each other, it provides a very strong supply chain, which in turn, positively impacts the economy. So, of course, collaboration is the key here.
So it provides a situation for robustness to the supply chains.
Of course,
which
absolutely,
and of course some of those suppliers, if not all the suppliers, very often they're providing key components or key supplies to that large buyer. So I guess maintaining robustness in the supply chain is very key. It is key for many corporates, large corporates, in enabling them to produce their end products. Okay, and what sort of things should financial institutions be looking at when they're considering integrating credit insurance and using it in their supply chain finance structures? What are the important things that they need to consider and look at?
So this is very important. Credit insurance, while on one hand it comes with risk mitigating tools in favor of the banks who are financing, but at the same time it comes attached with certain conditions, right? So if you do this, then only you are eligible for a claim. If you don't do this, then a claim may get denied. Now, this entire thing can go sour if terms and conditions are not met by the bank. So, of course, to integrate any kind of credit insurance structure in my financing structure, as a bank, I need to be totally aware of what conditions this is coming with, and structure my product which takes care of such conditions already, so that they are met in case there is a claim situation.
Okay, so it's important for financial institutions to look carefully at the terms and conditions and maybe shop around and make sure they've got the right arrangement that fits in with their requirements. Niraj, thank you very much for your time today, and we'll look forward to seeing you again in Dubai in a couple of months. And just to remind everybody, that's on the 5th and 6th of November at the Western Hotel in Dubai. Niraj, thank you again for your time today.
Thank you, Michael. It was a pleasure, and look forward to the event. Thank you.